Friends, in this podcast, I'm going to talk to you about mutual fund investing in post COVID markets. Mutual fund investing has had some of its best years. In fact, while most people were expecting this to slow down, we haven't yet seen a significant change in investor sentiment towards mutual fund investing. The habit of making regular investments in mutual funds is taking off and it's sustaining and it's like never before. So, in this context, so many people still very steadfast in investing in mutual funds. Many market watchers are wondering whether the mutual fund industry will be able to weather this difficult economic phase of negative growth uh, very comfortably. In my view, it's going to be a mixed bag. The reasons are many. First, mutual fund investors are still aligned towards comparing their 1 year mutual fund returns with a fixed deposit. They still have not come around to looking at equity as an asset class in which you may or may not have returns for a few years, and the subsequent years will more than compensate for the years of inadequate returns. The important thing is the phase of inadequate returns has just begun, and we are going to see this run for a while. But to me, a phase when returns are inadequate is the best phase to invest in mutual funds. It's a phase to build your investment books. Also, at any point in time, some themes may perform. So, while overall returns may be soft, returns in some themes can always be outlier. So, an investor has this opportunity before him to participate in mutual funds even during the difficult phases. Make some investments which perform counter cyclically and then move on to buying funds which are more diversified or which are in the riskier parts of the market. I'll give you an example. The last 1 year has been very good for investing in pharma and in gold funds. So these two funds have done very well. So if a good part of your portfolio was in pharma or gold funds, your returns would not have been as bad as the Nifty. In fact, they would have more than compensated. Importantly, if you had avoided small and mid caps during this phase, it gives you an opportunity to build your small and mid cap part of your portfolio at a time when the economy is very soft, when companies are not going to show growth, and when valuations gradually fall. So it gives you a window of opportunity to build those parts of the market over a period of 2 to 3 years. Effectively, mutual fund investing as an idea is best suited for every retirement saver and somebody who's planning to create a good wealth corpus. But you cannot blindly invest in expensive themes and in products which are not going to give you a risk reward. So, product selection is going to be very critical in the post COVID era. Importantly, where you thought you're going to get higher returns, you will have to give a longer investment gestation even to get moderate returns. And higher returns will come only over extended periods of time. So, there is an adjustment which every investor needs to do. Even in the so called safe spaces like large cap funds, focus funds, you still need to extend your investment horizon. Nobody is going to tell you that you need to invest for longer. But understand one thing, when markets fall 30%, you will first need to climb that wall of worry, and only then you're going to start making positive returns. And that wall of worry is not going to be easy to surmount in a negative growth economy. So 1 year will be lost just at this. And in the subsequent year only, the economy will probably go back to where it was in the beginning of 2020. Effectively, growth will only follow after a year and a half. So, This is something which is quite unusual for most investors as they have not seen the previous cycle. Or in the previous cycle, we did not have this many people invested in equity mutual funds as we do now. Therefore, this adjustment in expectation, in investment horizon, in the gestation has to happen in the minds of the investor. Importantly, the investor needs to travel through this phase comfortably and then stay on for even longer to reap the benefits of even what he has already done in the last 2 years. Alright, if you think you don't have the patience and you're going to walk out of mutual funds right now, what do you have as an alternative? The alternatives don't really look good because after paying tax, you won't even beat inflation. So your money will continuously lose value. The only alternative which you can do if you are extremely risk averse is buy gold in various forms. But there again, there will be a similar investment gestation. So an ideal mix for an investor would be to have gold, build the equity portfolio over the next 2-3 years, and then prepare for higher returns which will compensate for the phase that we are presently in. Effectively, there is no choice but to invest. Investing in equity is still a credible option, but be ready to give more time to your investments. Use that time to pack in more money and build a larger corpus with a wider presence in the economy. Create a portfolio which is representative of the emerging economy. Buy funds which will capture the future growth areas of the economy. Stay invested. Don't lose patience when you see negative returns. When you see that the markets are in a state of deep fear, try to scale up your portfolio. And importantly, understand that from here to outlier returns, you need to give at least 48 months. So we are in a phase where the economy is going to consolidate and then go back to growth. I'm sure you will agree with me that the best time to actually sell your investments is when that growth is clearly visible to everybody and everybody believes that that growth is sustainable and for real. The intermediate phase is clearly an investing phase to me and for you. Stay invested, happy investing, and continue to watch our channel. Thank you very much.